Hi. Let's learn about capitalized interest. Capitalized interest is the cost of borrowing to acquire or construct a long-term asset. Unlike an interest expense incurred for any other purpose, capitalized interest is not expensed immediately on the income statement of a company's financial statements. Instead, firms capitalize it, meaning the interest paid increases the cost basis of the related long-term asset on the balance sheet. Capitalized interest shows up in installments on a company's income statement through periodic depreciation expense recorded on the associated long-term asset over its useful life. Capitalized interest is part of the historical cost of acquiring assets that will benefit a company over many years. Because many companies finance the construction of long-term assets with debt, generally accepted accounting principles allow firms to avoid expensing interest on such debt and include it on their balance sheets as part of the historical cost of long-term assets. Typical examples of long-term assets for which capitalizing interest is allowed include various production facilities, real estate, and ships. Capitalizing interest is not permitted for inventories that are manufactured repetitively in large quantities. From the perspective of accrual accounting, capitalizing interest helps tie the costs of using a long-term asset to earnings generated by the asset in the same periods of use. Capitalized interest can only be booked if its impact on a company's financial statements is material. When booked, capitalized interest has no immediate effect on a company's income statement, and instead, it appears on the income statement in subsequent periods through depreciation expense. The only difference between capitalized interest and expensed interest is the timing in which the expense shows up on the income statement. Accrued interest is the amount of interest that has accumulated on a loan since the last payment was made. In some cases, accrued interest and capitalized interest can be the same, but the specific treatment of accrued interest does not always prevail itself to being capitalized. Capitalized interest on student loans is the interest that accrues on a loan and is added to the principal balance of the loan. It's important to understand the implications of capitalized interest and respect its effects on loan balance and repayment plans. Consider a company that builds a small production facility worth $5 million with a useful life of 20 years. It borrows the amount to finance this project at an interest rate of 10%. The company capitalizes interest by recording a debit entry of $500,000 to a fixed asset account and an offsetting credit entry to cash. At the end of construction, the company's production facility has a book value of $5.5 million, consisting of $5 million in construction costs and $500,000 in capitalized interest. Capitalized interest is simply an interest assessment charged against an outstanding principal balance. However, instead of expensing the charge right away, the interest is capitalized as part of the cost of creating a long-term asset. Companies recognize capitalized interest by including it in the cost basis of the asset being generated and depreciating the asset over time. The timing of interest being capitalized will greatly vary depending on the interest itself. For student loans, interest is capitalized as part of the loan agreement and type of loan. On the other hand, interest is often capitalized during construction when an asset's development is underway. Companies may be interested in capitalizing interest if they want to defer the interest expense deduction to future periods. This is usually favorable as the company will likely have rent income from the asset being developed in the same period the interest expense could be taken. Capitalized interest is calculated the same way as any other type of interest. The prevailing rate of interest is multiplied by the prevailing principal balance of debt for a given period, and considerations are made for the number of days outstanding. This balance is then added to the original principal balance amount. Here are 5 key takeaways. 1. Capitalized interest is the cost of borrowing to obtain a long-term asset. 2. Unlike typical interest expenses, capitalized interest is not expensed immediately on a company's income statement. 3. Because many companies finance long-term assets with debt, companies are allowed to expense the assets over the long term. 4. By capitalizing the interest expense, companies are able to generate revenue from the asset in order to pay for it over time. 5. Capital interest is expensed over time as part of the depreciation process of the asset. Hope this would help. Thanks for watching.